There is a secret language spoken by the truly wealthy, a language not of spreadsheets and stock tickers, but of fortresses and moats. It's a language that Warren Buffett mastered decades ago, and it allowed him to see the business world not as a chaotic battlefield of competition, but as a map of kingdoms, some destined to fall, and a select few built to last for eternity. Most investors, most entrepreneurs, spend their entire lives trying to figure out how to win a brutal, bloody fight. They look for the strongest warrior, the fastest horse, the sharpest sword. Buffett's genius was to realize that the greatest victory is avoiding the fight altogether. The secret to generational wealth, the kind that reshapes families and rewrites futures, is not in finding a company that can win a war, but in finding a company that is so powerful, so dominant, that no one even dares to declare war upon it. This is the search for the unassailable business, the economic castle protected by a deep, wide, and alligator-infested moat. It is the core of all value investing, the central pillar of Buffett's entire philosophy, and today we are going to deconstruct it piece by piece, translating that secret language into a practical blueprint you can use to change your financial destiny. We are not just talking about a stock analysis technique, we are talking about a fundamental shift in how you see the world of money and commerce. This is the difference between betting on a gladiator and owning the entire Colosseum. Our journey begins with the most potent and perhaps most misunderstood form of competitive advantage, the power of an idea, a feeling, a name. This is the intangible asset moat, a fortress built not of bricks and mortar, but of pure perception in the human mind. It is the magic that allows a company to sell a product for 10 times the price of its physical equivalent, the alchemy that turns sugar and water into a symbol of happiness, and the force that makes a simple piece of jewelry a promise of eternal love. To understand this, we must travel back to 1972. Warren Buffett and his partner, Charlie Munger, were walking through the bustling aisles of a company they were considering for acquisition. This wasn't a technology company promising to change the world. It wasn't a pharmaceutical giant with a life-saving patent. It was See's Candies, a quaint, family-owned chocolate business based in California. The numbers were good, but not spectacular. The assets were simple: kitchens, delivery trucks, and retail stores. On paper, it was a solid, if unremarkable business. The sellers wanted $30 million. Buffett and his then-partner, David Gottsman, thought it was worth no more than $25 million. Based on the tangible assets, the book value, it was a steep price. The negotiations stalled. Buffett was about to walk away. This is a critical moment. The typical investor, the spreadsheet-driven analyst, would have concluded the price was too high and moved on. They would have seen only the cost of cocoa beans and machinery. But Charlie Munger saw something else. He saw the moat. He urged Buffett to reconsider, famously telling him that he was being a fool for letting a few $1 million get in the way of acquiring a truly exceptional business. Munger understood that they weren't just buying chocolate-making equipment. They were buying a piece of their customers' hearts. They were buying decades of happy birthdays, Valentine's days, and Christmas mornings. They were buying the loyalty of generations of Californians who associated the black and white See's box with celebration, comfort, and quality. This was a business where customers would drive past 10 other candy stores to get to a See's. It was a business where, every holiday season, the lines would snake out the door. Munger convinced Buffett to pay the $30 million. Later, Buffett would call this decision a pivotal moment in his education as an investor. See's Candies became his prototype for the perfect business. Why? Because of its pricing power. Every year, around Christmas, Buffett and his then CEO, Chuck Huggins, would have a conversation. Huggins would say, "Mr. Buffett, I think we can raise the price 10% this year." And Buffett would say, "Just 10%, Chuck? Why not more?" They discovered they could raise the price of their chocolates every single year without any meaningful drop in sales. Customers didn't even blink. They weren't buying a pound of chocolate based on a cold calculation of its cost per ounce. They were buying a tradition. They were buying a guarantee of quality. They were buying See's. In the first year after Berkshire Hathaway bought the company, See's earned about $4 million pre-tax. By the early 2000s, it was earning $60 million a year. Over the decades, it has generated over $2 billion in profit for Berkshire, all while requiring very little additional capital investment. It was a money machine fueled not by factories, but by feelings. That $30 million purchase taught Buffett a lesson that would be worth hundreds of billions. The most valuable asset a company can own is a pristine reputation in the mind of its customers. This brand equity is a form of competitive advantage that is almost impossible for a competitor to replicate. You can build a new factory, you can copy a product design, you can even hire away key employees, but you cannot fake a century of trust. You cannot manufacture nostalgia. This is the essence of the intangible asset moat. It's the reason people pay $3 for a cup of Starbucks coffee when they could make it at home for 30 cents. It's why parents will only buy Johnson & Johnson baby shampoo, trusting the "no more tears" promise implicitly. It's the force that allows Coca-Cola to dominate the global beverage market despite its core product being a simple, easily replicable sugar water formula. The moat isn't the formula. The moat is the feeling you get when you see that red and white logo. This is the ultimate goal in business strategy and a cornerstone of any sound long-term investing plan. The reason this intangible moat is so powerful lies deep within the architecture of the human brain. We are not the rational, calculating machines we like to believe we are. Our decisions are guided by a complex web of cognitive biases, shortcuts, and emotional triggers. Companies with strong brand equity don't just sell products. They masterfully navigate these psychological currents. The primary principle at play is the affect heuristic. This is a mental shortcut where people let their emotions, their affect, shape their interpretation of information. When you see a brand you trust and love, like See's Candies, you don't perform a detailed financial analysis of the purchase. You don't compare its ingredients to a competitor's. You simply feel good about it. The positive emotions associated with past experiences, the happiness, the nostalgia, the feeling of giving a high-quality gift, flood your decision-making process. This positive affect creates a halo effect, causing you to overlook minor negatives, like a higher price, and focus on the perceived positives. A competitor can offer a cheaper chocolate, but they can't offer the same warm feeling. Their product is just candy. See's is a cherished memory. This is a concept that is critical for anyone in wealth management or anyone providing entrepreneurship advice to understand. You are not just building a product, you are building a feeling. Closely related is the status quo bias. Human beings are creatures of habit. We have a powerful, often irrational preference for the current state of affairs. Changing a behavior, even a simple purchasing decision, requires cognitive effort and carries a perceived risk. What if the new brand isn't as good? What if I'm disappointed? For the customer who has been buying See's Candies for 20 years, the decision to switch to a new brand is not a simple one. The "don't fix what isn't broken" instinct is incredibly strong. A strong brand becomes the default choice, the path of least resistance. Each successful transaction, each happy holiday, reinforces this bias, making the moat wider and deeper with every passing year. This is the bedrock of quality investing, finding companies that have become the ingrained default choice in their customers' lives. A third psychological force is the concept of social proof. We are social creatures, and we constantly look to others for cues on how to behave. When a brand becomes iconic, like Coca-Cola or Apple, it benefits from overwhelming social proof. The fact that billions of people have chosen this brand before you acts as a powerful endorsement. It signals safety, quality, and social acceptance. When you see a line out the door at a See's Candies store during Christmas, you don't think, "Oh, what a long wait." You think, "Wow, this place must be incredible." The crowd itself becomes the most powerful form of marketing. The brand's dominance becomes a self-fulfilling prophecy. These psychological forces combine to create a formidable barrier to entry. A new competitor in the premium chocolate space isn't just fighting seas on price or quality. They are fighting against decades of ingrained habits, cherished memories, and overwhelming social consensus. It's a battle that is almost impossible to win, which is why Buffett was ultimately willing to pay a premium. He wasn't buying a balance sheet, he was buying a deeply embedded psychological phenomenon. This deep understanding of human behavior, not just financial analysis, is what separates legendary investors from the crowd. They understand that the most valuable real estate in the world isn't in New York or London. It's the space a brand occupies, rent-free, inside the consumer's mind. So how do we translate this powerful theory into a practical, actionable tool? How can you, as an investor looking for your next long-term investing opportunity, or as an entrepreneur sketching out small business ideas, apply this mental model? The answer is to conduct what I call a brand power audit. This is a blueprint, a checklist you can use to measure the strength of a company's intangible asset moat. It consists of 4 critical questions. First, does this company have pricing power? This is the single most important test of a great business, as Buffett himself has stated. If a company has to hold a prayer session before raising prices by a fraction of a percent, it does not have a strong brand. If it can consistently raise prices year after year, faster than the rate of inflation, without losing significant business, then you have found something special. To test this, you must become a business historian. Look at the company's pricing history over the last decade. Look at its gross margins. Are they consistently high and stable, or even expanding? A company like See's Candies or Coca-Cola can pass on rising input costs, like sugar or aluminum, to the consumer with ease, protecting their high profit margin. A generic, commoditized business cannot. Their margins get squeezed because they have no power over their customers. The second question in your audit is the purchase decision driven by emotion or by calculation? Think about the product. Is it something a customer buys using a spreadsheet, or is it something they buy using their heart? People buy steel beams based on specifications and price. They buy Tiffany & Company engagement rings based on love and status. People choose a budget airline based on the lowest possible fare. They choose to go to Disneyland based on the promise of creating magical family memories. Businesses that sell to the heart have a much stronger moat than those that sell to the calculator. This is a core concept in business strategy, decommodifying your product by connecting it to a powerful human emotion. Third, you must ask, would a customer feel a sense of loss if this brand disappeared tomorrow? This is the empty shelf test. If a particular brand of paper towels is out of stock, most people will just grab the one next to it without a second thought. If the local See's candy store were to close down, it would be a genuine tragedy for many of its loyal customers. They would feel a real emotional loss. This sense of irreplaceability is the hallmark of a powerful brand. True brand equity isn't just about recognition, it's about affection and a sense of identity. A great brand becomes part of its customers' lives. The final question in the audit is, how much does the company spend on marketing to maintain its position? This is a crucial counterintuitive point. A truly powerful brand, one with a deep moat, often needs to spend less on marketing as a percentage of sales than its weaker competitors. Coca-Cola's marketing is more about maintaining its cultural omnipresence than desperately trying to convince people to try its product for the first time. Its brand is a massive asset that works for it 24/7. A weaker competitor, however, has to constantly shout to be heard. They are on a marketing treadmill, spending huge sums of money just to stay in the same place. A strong brand has gravity. A weak brand has to fight against it. By running any potential investment or business idea through this 4-part brand power audit, pricing power, emotional connection, irreplaceability, and marketing efficiency, you can move beyond a superficial stock analysis and begin to see the underlying competitive reality. You start to think like Buffett, focusing not on the fleeting numbers of a single quarter, but on the durable, near-permanent power of a brand built over decades. To truly appreciate the wisdom of owning a business with a powerful, intangible moat, we must examine the alternative, the path taken by the 99% of businesses and investors. This is the world of the commodity, the land of brutal, soul-crushing price competition. This is the antithesis of the See's Candies model. A commoditized business is one where the customer perceives little to no difference between competing products, aside from the price. Think of basic agricultural products like wheat or soybeans, raw materials like copper or lumber, or even many modern technology components like DRAM memory chips. In these industries, the fight for survival is relentless. The only weapon you have is your price tag. If your competitor lowers their price by 1 cent, you must lower yours by 1 cent, or you will lose the sale. This creates a vicious cycle known as the race to the bottom. Companies in these industries are trapped on a treadmill of capital expenditure. They must constantly invest in new, more efficient machinery just to keep their costs low enough to survive. Any technological breakthrough is quickly copied by competitors, and any temporary advantage is eroded almost instantly. The result is chronically low profit margins and dismal returns on capital. Consider the airline industry, which Buffett famously described as a, quote, death trap for investors. For most of its history, flying has been a commoditized service. Most customers choose their flight based on 2 factors: schedule and price. Brand loyalty is fleeting. While some airlines have tried to build brands around service or luxury, for the vast majority of the market, a seat is a seat. This has led to decades of bankruptcies, brutal price wars, and massive value destruction. A company like Southwest Airlines managed to succeed by creating a different kind of moat, a cost advantage moat, which we will discuss later. But for the traditional carriers, the industry has been a financial black hole. The path of the 99% is also littered with companies that chase growth without first building a moat. This is the siren song of Silicon Valley and the venture capital world. A startup can show spectacular revenue growth for a few years, attracting billions in investment. But if that growth is not protected by a durable competitive advantage, it is ultimately worthless. Consider the meal kit delivery industry. Companies like Blue Apron burst onto the scene with a novel idea and grew at an incredible pace. Investors poured money in, captivated by the top-line growth. But what was their moat? There was no real brand loyalty. Customers would happily switch to a competitor offering a better introductory discount. There were no switching costs. There was no network effect. The barriers to entry were incredibly low, and soon the market was flooded with copycats. The result was a catastrophe for investors. The stock price collapsed as the brutal reality of a commoditized business with no moat set in. The 99% of investors fall for this trap over and over. They are mesmerized by exciting stories, technological promises, and rapid growth charts. They fail to ask the single most important question: what prevents someone else from coming along and doing the exact same thing, but cheaper? They mistake a temporary land grab for the construction of a permanent fortress. The entrepreneur who follows this path faces a life of constant stress, always looking over their shoulder, always one step away from being put out of business by a new, lower-cost competitor. They are forced to compete on price, which means they can never build up the financial reserves to invest in true long-term innovation or weather an economic downturn. This is a world of survival, not of thriving. By choosing to play in a commoditized field, you are choosing to enter a fight where the only winning move is not to play at all. This is why a deep understanding of competitive advantage is the most crucial piece of entrepreneurship advice one can receive. Don't just build a product, build a fortress around it. The final piece of the puzzle is understanding how this abstract concept of brand equity translates into cold, hard numbers on a financial statement. How does the magic of a See's Candies manifest in a way that creates billions of dollars in real, tangible wealth? The connection is direct, measurable, and profound. First, as we've established, is the impact on the top line: revenue. A strong brand gives a company pricing power. This allows it to increase revenue year after year simply by raising prices, without needing to sell significantly more units. This is the holy grail of business. Growth that comes from price increases is far more profitable than growth that comes from selling more volume, as it often requires little to no additional capital investment. You don't need a new factory to charge 5% more for a box of chocolates. This leads directly to the second and most critical financial indicator, the high profit margin. Specifically, the gross margin. Gross margin is calculated as revenue cost of goods sold / revenue. It tells you how much profit a company makes on each dollar of sales before accounting for overhead and other operating expenses. Companies with strong brands, like See's, have incredibly high and stable gross margins. They can charge a premium price for their product, while their input costs, cocoa, sugar, labor, are similar to their competitors. That massive gap between the selling price and the cost of the product is pure profit, a direct financial return on their brand equity. A commoditized business, on the other hand, will have razor-thin gross margins because their selling price is tethered directly to their cost. This is a critical metric in any serious company analysis. The third connection is on the expense side of the income statement, specifically with selling, general, and administrative (SG&A) expenses. A powerful brand is an asset that works for you. It lowers your customer acquisition cost. You don't have to spend as much on advertising to convince someone to buy a Coke or an iPhone. The brand does the heavy lifting. This leads to greater marketing efficiency and lower SG&A as a percentage of sales, which in turn boosts the operating margin and, ultimately, the net income. Look at the financial analysis of a company like Nike versus a lesser-known shoe brand. Nike's brand allows it to command premium prices, high gross margin, while its global recognition creates demand organically, making its marketing budget far more efficient. Finally, and perhaps most importantly for a long-term investor, is the impact on return on tangible capital employed, ROTC. This is a favorite metric of Buffett's. It measures how much profit a business generates for each dollar of physical assets it uses. A business like See's Candies is a miracle of ROTC. It required an initial investment in kitchens and stores, but since then, it has been able to grow its profits immensely with very little need for additional capital. The growth wasn't driven by building more and more factories. It was driven by the intangible brand, which is an asset that doesn't appear on the balance sheet but generates the majority of the returns. This is what Buffett means when he talks about a capital-light business. These businesses are true wealth creation machines. They produce enormous amounts of free cash flow that can then be returned to the owners or reinvested in other ventures. A capital-intensive, commoditized business like an airline or a steel mill is the opposite. It must constantly reinvest its earnings back into new planes and furnaces just to stay competitive. The cash gets trapped in the business, never making it to the owners' pockets. The intangible asset moat, therefore, is not just a feel-good marketing concept. It is a powerful economic engine that manifests as superior pricing power, higher profit margins, lower operating costs, and phenomenal returns on capital. It is the numerical signature of a truly great business. The second great fortress a company can build is not based on what customers love, but on what they fear. This is the moat of high switching costs. A business with this competitive advantage makes it so painful, so expensive, or so inconvenient for a customer to leave that they become, for all intents and purposes, a captive. It's a moat built on inertia and the deep-seated human aversion to change. To understand its power, we must look at one of Buffett's longest-held and most successful investments, American Express. He first invested in the company in the 1960s after the infamous salad oil scandal, a story of fraud that nearly bankrupted the company and sent its stock price plummeting. While other investors panicked, seeing only the scandal, Buffett did his homework. He went out and talked to merchants, customers, and even competitors. He discovered something profound. Despite the negative headlines, customers were not abandoning their American Express cards. Travelers were not cashing in their travelers' checks. And most importantly, merchants were not taking down the American Express accepted here signs. Why? Because the company was protected by a massive moat of switching costs, a two-sided one that formed a virtuous cycle. For the cardholder, especially the business traveler of that era, the American Express card was a vital piece of infrastructure. It was a symbol of creditworthiness. Their expense reports were built around it. Their travel routines depended on it. To switch to a different card would mean changing established habits, relearning systems, and potentially losing the prestige associated with the brand. The inconvenience, the friction, was a powerful deterrent. But the real lock-in was on the merchant side. A restaurant or hotel that refused to accept American Express would be telling a huge segment of its most affluent customers to go elsewhere. They would be willingly turning away business. The cost of 27 being part of the American Express network was far greater than the fees the company charged for each transaction. This created a powerful feedback loop. The more cardholders Amex had, the more essential it became for merchants to accept the card. And the more merchants that accepted the card, the more valuable the card became to its holders. This is a classic example of a two-sided network, but its foundation is built on switching costs. For either side to leave, they would have to endure significant pain, either the loss of convenience for the consumer or the loss of revenue for the merchant. Buffett recognized that this structure was far more valuable than the temporary damage from the salad oil scandal. He famously invested 40% of his partnership's capital into the company, a bet that paid off spectacularly. The moat held. The business recovered and thrived, becoming a cornerstone of the Berkshire Hathaway investment portfolio for decades. This story reveals a critical insight into business strategy and quality investing. Sometimes the best business isn't the one with the most beloved product, but the one whose product is most deeply embedded in the customer's life or workflow. Think about the accounting software your small business uses. You might complain about its flaws. You might dislike its user interface. But the thought of migrating years of financial data to a new system is a nightmare. The potential for lost data, the time spent retraining employees, the risk of something going wrong, these are massive switching costs. The software company doesn't have to be perfect. It just has to be good enough to prevent you from undertaking the monumental task of leaving. This is the power of creating customer captivity. It's not about trapping customers against their will. It's about making your service so integral to their lives that the alternative becomes unthinkable. The immense power of switching costs as a competitive advantage is rooted directly in some of the most predictable and potent biases of the human mind. The architect of a business with high switching costs is, in effect, a master practical psychologist. The primary cognitive bias at work here is loss aversion. Pioneering research by psychologists Daniel Kahneman and Amos Tversky showed that for most people, the pain of losing something is psychologically about twice as powerful as the pleasure of gaining something of equal value. When a customer considers switching from an established provider to a new one, they frame the decision in terms of potential losses. They think about losing their existing data, losing their familiarity with the user interface, losing their accumulated loyalty points, or losing the established relationships they have with customer service. The potential gain from the new service, perhaps a slightly lower price or a few new features, has to be enormous to overcome the powerful psychological pain of those potential losses. The incumbent provider, the one with the high switching costs, benefits directly from this asymmetry. They don't have to be twice as good as the competition. They just have to avoid being so bad that the customer's pain of staying outweighs their fear of leaving. Another critical principle is the endowment effect. This is our tendency to overvalue things simply because we own them. The software a company has used for 10 years, the bank they've been with for a generation, the mobile ecosystem they are a part of. Customers imbue these things with more value than they might objectively have. It's asterisk their software, their soft bank. A new competitor comes along and offers a technically superior or cheaper product, but they are asking the customer to give up something they already possess and feel a sense of ownership over. The new offering is just a potential, an unknown. The existing service is a concrete part of their identity and workflow. This creates a powerful bias in favor of the incumbent. They are not competing on a level playing field. The challenger must not only be better, but they must be so overwhelmingly better that it shatters the customer's endowed value in their current solution. This principle is vital for entrepreneurs to understand. If you are entering a market dominated by a player with high switching costs, your value proposition must be 10 times better, not just 10% better. Finally, we see the impact of cognitive load and the path of least resistance. Switching providers requires effort. It requires research, planning, execution, and often a period of frustrating adjustment. Our brains are inherently lazy and are wired to conserve energy. When faced with a complex, effortful task, like migrating a company's entire IT infrastructure to a new platform versus doing nothing, the default choice is almost always to do nothing. High switching costs exploit this by making the process of leaving seem as daunting and energy-intensive as possible. The more steps, the more potential pitfalls, the more data to transfer, the higher the cognitive load of the switch becomes. This creates a powerful inertia that keeps customers locked in, even in the face of better alternatives. A smart business strategy, therefore, is not just about delivering value, but about weaving that value into the very fabric of the customer's operations, creating a web of dependencies that makes the thought of untangling it simply too exhausting to contemplate. This is the psychological genius behind a high switching cost moat. It aligns a company's business model with the fundamental hardwired laziness and risk aversion of the human brain. How can you, as an investor performing a company analysis or an entrepreneur designing a business, systematically identify or create a switching cost moat? Here is a practical blueprint, a step-by-step mental model for building what can be called customer captivity. This process involves 4 distinct layers of integration. The first layer is procedural integration. This occurs when your product becomes a critical part of a customer's daily workflow or standard operating procedure. Think of a company like Adobe and its Creative Suite. For millions of graphic designers, video editors, and marketing professionals around the world, Photoshop and Premiere are not just tools. They are the environment in which they work. Their skills, their careers, are built upon mastery of this specific software. To switch to a competitor would mean relearning decades of ingrained habits and keyboard shortcuts. The cost of lost productivity during that transition would be immense. To build this, an entrepreneur must ask, how can I make my product the verb for what my customer does? Google did this with search. Xerox did it with copying. You must aim to become the default, the standard, the platform upon which your customer's own value creation depends. The second layer is financial integration. This involves creating financial incentives and penalties that make leaving costly. The most common examples are termination fees for breaking a contract early. But more subtle and powerful versions exist. Think of a bank that offers a lower mortgage rate to customers who also have their checking account and investment portfolio with them. To switch any one of those services would cause the rates on the others to rise. The customer is financially entangled. For investors doing stock analysis, look for businesses with high levels of recurring revenue that are locked in by multi-year contracts. This creates a predictable, stable cash flow stream that is highly valuable. For entrepreneurs, consider loyalty programs that offer escalating rewards, making the prospect of starting over from zero with a competitor seem deeply unappealing. The third layer is technological integration. This is one of the most powerful forms of switching cost in the modern economy. It happens when your product becomes deeply embedded in a customer's technology stack. An excellent example is a company that provides the core database software for a large corporation. That software is connected to dozens of other applications within the company. To rip it out and replace it would be like performing open-heart surgery on the organization's IT infrastructure. It would be a multi-year, multi-million-dollar project fraught with risk. The company that owns that central position has an almost insurmountable moat. Entrepreneurs building B2B software should always think about integration. Can your product become the central hub that connects to all the other tools your customer uses? If you can achieve that, you have built a powerful fortress. The final and deepest layer is personal integration. This is where the product becomes intertwined with a customer's personal data, history, and even identity. The most obvious example is Apple's ecosystem. A user's photos, music, contacts, messages, and apps are all stored and seamlessly synchronized across their iPhone, iPad, and Mac. The thought of leaving this walled garden is terrifying for many. It would mean manually migrating years of digital life, a task so daunting that most people would rather just buy the next iPhone. For investors, identifying companies that are building these kinds of personal data ecosystems is a key to finding long-term investing gems. For entrepreneurs, the goal is to become the trusted custodian of something your customer values deeply, whether it's their financial history, their professional network, or their family photos. By methodically thinking through these 4 layers, procedural, financial, technological, and personal, you can build a business that doesn't just attract customers, but captures them. You create a system where the value of staying consistently outweighs the effort of leaving, leading to a durable, predictable, and highly profitable enterprise. The path of the 99% is to completely ignore the concept of switching costs and, as a result, exist in a state of constant customer churn. This is the world of the, quote, leaky bucket, where businesses are forced to spend enormous amounts of money on sales and marketing just to replace the customers that are constantly flowing out the bottom. This antithesis to the high switching cost model is defined by one word: frictionlessness. Businesses in this category make it as easy as possible to leave. They compete on having no contracts, no commitments, and no lock-in. While this can be an effective strategy for initial customer acquisition, it creates a terrifyingly fragile business model. Consider the hyper-competitive world of consumer mobile apps or subscription streaming services. A user can try Netflix for a month, then cancel with a single click and switch to Disney Plus the next day. They can use Spotify for a while, then jump to Apple Music to take advantage of a free trial. There is almost zero friction. The cost of switching is measured in seconds, not in dollars or hours of effort. This forces these companies into a relentless and astronomically expensive content arms race. They must constantly produce new hit shows, new exclusive albums, new killer features, just to keep their customers from wandering off. They are on a content treadmill that never stops, and a single misstep or a weak content slate can lead to a mass exodus of subscribers. The financial statements of these companies often show massive revenues, but also equally massive content and marketing expenses, leading to thin or non-existent profit margins. This is a high-wire act, not a durable fortress. Another classic example is the generic retail or e-commerce business. If you are selling the same products that dozens of other online stores are selling, what reason does a customer have to be loyal to you? Their only incentive is price. They will come to you for a sale, and they will leave you the moment a competitor offers a slightly better deal. There is no switching cost. The customer has no data stored with you, no workflow integration, no loyalty built up. They are a mercenary, not a citizen of your kingdom. This forces the business into a constant battle for attention, spending heavily on Google Ads, Facebook marketing, and promotions. It's a game of arbitrage, not of building long-term value. Investors who fall for this trap are often seduced by vanity metrics like daily active users or gross merchandise volume. They see the top-line numbers growing and assume a valuable business is being built. They fail to look deeper at the underlying unit economics and the churn rate. They don't ask the crucial question, how many of these customers will still be here in a year? A business with high churn is like trying to fill a bathtub with the drain open. You can pour in a lot of water, but you'll never end up with much. The entrepreneur who operates in this world lives a life of perpetual anxiety. Their customer base is a transient population, not a stable asset. They are forever hunting for the next sale, the next promotion, the next gimmick to get people in the door, knowing full well that those same people will be gone tomorrow. They are building their house on sand, while the wise entrepreneur, the one focused on building switching costs, is slowly, patiently, laying a foundation of solid rock. The financial manifestation of a high switching cost moat is one of the most beautiful things an investor can find on a company's financial statements. It is the signature of a business that is both durable and immensely profitable. The most direct and powerful impact is on a metric called customer lifetime value, or LTV. LTV is a prediction of the net profit attributed to the entire future relationship with a customer. A business with high switching costs has a dramatically higher LTV than a business with high churn. Because customers stick around for years or even decades, they make recurring purchases, generating a long, predictable stream of revenue from a single initial acquisition. This brings us to the second critical financial connection, the LTV to CAC ratio. CAC stands for Customer Acquisition Cost. This is the ratio that separates great businesses from terrible ones. A business with high churn, low LTV, and high marketing costs, high CAC, might have a ratio of 1-to-1 or even less, meaning they are spending as much to acquire a customer as that customer will ever generate in profit. This is a recipe for bankruptcy. A business with high switching costs, however, can have a phenomenal LTV to CAC ratio of 5-to-1, 10-to-1, or even higher. They spend money to acquire a customer once, and that customer then pays them back many times over for years to come. This is the engine of scalable, profitable growth. A financial analysis that ignores this ratio is missing the entire story. The third financial signature is the predictability and stability of revenue. Wall Street loves predictability. A business with high switching costs, often operating on a subscription or recurring revenue model, can forecast its future revenue with a high degree of accuracy. This reduces the perceived risk of the business, which in turn leads to a higher valuation multiple. Compare a software-as-a-service SaaS company with 95% annual customer retention to a project-based consulting firm. The SaaS company's revenue is like an annuity. The consulting firm's revenue starts at zero every year. An investor will pay a much higher price for the predictable stream of cash flow. Fourth, high switching costs often lead to what is known as negative churn. This is a magical state that is the ultimate goal of any subscription business. Negative churn occurs when the additional revenue from existing customers, through upsells, cross-sells, or price increases, is greater than the revenue lost from customers who cancel. This means the business can grow its revenue even if it doesn't add a single new customer. This is only possible in an environment where customers are locked in and see increasing value in the service over time, making them willing to pay more. It's a financial fountain of youth. When you see this phenomenon in a company's financials, you have likely found a business with an exceptionally strong competitive advantage. In summary, the switching cost moat is not an abstract concept. It is a powerful economic force that translates directly into a higher customer lifetime value, a more efficient customer acquisition model, more predictable revenues, and the potential for magical, negative churn. It creates a business that is not just growing, but is growing profitably and sustainably. A fortress that becomes stronger and more valuable with every customer it captures. The third great moat, and perhaps the most powerful in the digital age, is the network effect. This is a unique and almost magical competitive advantage where a product or service becomes more valuable as more people use it. Unlike a physical product like a candy bar, which has the same value whether 1 person or 1 million people eat it, a network product's value is directly proportional to the size of its user base. It is a moat that builds itself, a fortress whose walls grow higher and thicker with every new citizen who enters. The classic historical anecdote to illustrate this is not one of Buffett's direct stock picks in its infancy, but rather his investment in institutions that benefit from a deeply entrenched network, the credit rating agencies like Moody's. For decades, Moody's business has been to assess the creditworthiness of corporations and governments and assign them a rating, like AAA or B-. On the surface, this seems like a simple information business. But its true power lies in the network effect. The value of a Moody's rating is not in the private analysis itself, but in its universal acceptance. A company gets a rating from Moody's because that is the rating that every major pension fund, insurance company, and bond investor in the world uses as a benchmark. The investors in turn demand a Moody's rating, because that is the standard the entire market has agreed upon. It's a closed loop. For a new credit rating agency to compete, it wouldn't be enough to have smarter analysts or a better model. Their ratings would be worthless because no one would use them. And no one would use them because they are worthless. It's a chicken and egg problem that is nearly impossible to solve once a dominant network is established. The more issuers that get rated by Moody's, the more essential it becomes for investors to use those ratings. And the more investors that rely on those ratings, the more crucial it becomes for issuers to get one. This network effect allowed Moody's to enjoy decades of pricing power and what Buffett and Munger would describe as an unregulated monopoly. They could raise their prices for ratings consistently, and companies had no choice but to pay. Where else were they going to go? This is the essence of a network effect moat. It creates a winner-take-all or winner-take-most dynamic. Once a network reaches a certain critical mass, it becomes the standard, the default, the Schelling point that everyone coordinates around. Think of the English language. It may not be the most efficient or logical language, but its value comes from the fact that billions of people speak it. Its network is its power. Buffett's understanding of this dynamic has been a key component of his investing strategy. While he famously avoided tech stocks for many years, his core philosophy aligns perfectly with the power of networks. He seeks businesses that are the established standard, the one that is so deeply entrenched that competition becomes almost irrelevant. The power of Moody's wasn't in its financial analysis prowess. It was in its status as the accepted lingua franca of credit risk. This is a competitive advantage of the highest order, a moat that doesn't just repel attackers, but makes the very idea of an attack seem futile. The reason network effects create such powerful and durable moats is because they tap into our most fundamental instincts as social creatures. The psychological principles underpinning the network effect are deep-seated and difficult to overcome. The most prominent is social proof, which we touched on earlier, but here it takes on an exponential power. When a network grows, it becomes its own best marketing tool. The sheer size of the user base acts as an overwhelming signal of value and safety. Why did you join Facebook or Instagram? It wasn't because of a clever ad campaign. It was because all your friends were already there. The decision was practically made for you. This creates a bandwagon effect, a form of groupthink, where individuals adopt a certain behavior or belief because everyone else is doing it. As the network grows, the pressure to join for those on the outside increases. Staying off the network starts to feel like a social or professional liability. You risk being left out of the conversation, excluded from the community, or unable to participate in the new economy. This fear of missing out, or FOMO, is a powerful motivator that drives the network's growth in a self-perpetuating cycle. Another key psychological principle is the idea of coordination and interoperability. Humans have a fundamental need to coordinate with each other. A network often becomes the de facto platform for this coordination. Think of the Microsoft Windows operating system in the 1990s. The reason it became so dominant was not just the software itself, but the network of users, software developers, and hardware manufacturers that all built upon it. A developer would write software for Windows because that's where the users were. Users would buy Windows PCs because that's where the software was. Hardware manufacturers would build drivers for Windows because that's what both users and developers demanded. To choose a different operating system like a Mac or Linux was to choose to be outside of this massive interoperable network with fewer software choices and more compatibility headaches. The network effect creates a powerful incentive for everyone to standardize on a single platform, making the dominant player's position increasingly unassailable over time. This is a crucial concept for scaling a business. Can you become the platform that everyone else in your industry needs to coordinate through? Finally, there's a simple, rational calculation of utility. In many cases, the utility of the service genuinely increases with a number of users. A telephone is useless if you're the only person who has one. Its value increases with every single person who gets connected to the network. An online marketplace like eBay or Amazon is more valuable to buyers because it has more sellers, which means more selection and lower prices. It's more valuable to sellers because it has more buyers, which means a larger potential market. This direct increase in utility creates a powerful pull that draws in more users, which in turn increases the utility further, creating a flywheel of growth that can become unstoppable. The psychology of network effects is a potent cocktail of social pressure, fear of exclusion, and rational self-interest. Once a company has successfully harnessed these forces to build a network, it creates a competitive advantage that is not just difficult to overcome, but that actively fights on the company's behalf, pulling more and more of the market into its orbit. So how can you, as an investor or entrepreneur, spot a burgeoning network effect and understand its strength? Here is a practical blueprint, a mental model for analyzing network-based businesses. It's called the Network Value Framework, and it has 3 key components. The first component is to identify the type of network. Not all network effects are created equal. The most powerful is a direct network effect, like the telephone or Facebook, where each new user directly increases the value for all other users. The second type is an indirect or two-sided network effect, like we saw with American Express or with a video game console. The console, the platform, becomes more valuable to gamers as more developers create games for it, and it becomes more valuable to developers as more gamers buy the console. Other types include data network effects, where a product gets smarter as it collects more user data, like Google Search or Waze, and marketplace network effects like eBay or Airbnb. Identifying the specific type of network is the first step to understanding how its moat will develop. The second component of the framework is to assess the critical mass threshold. A network is useless until it reaches a certain minimum size, a point of critical mass where the value it provides becomes self-sustaining. The key question for a young, network-based business is whether it can get there. This is often the hardest part of building the business, the cold start problem. How do you convince the first users to join when the network has no value? This is where a lot of entrepreneurship advice focuses. Strategies like subsidizing one side of the market, e.g., Uber giving free rides to early passengers, or creating a single-player utility to attract users before the network is built, e.g., Instagram starting as a photo filter app. As an investor doing a company analysis, you must look for evidence that the company has crossed or is about to cross this critical mass threshold. Look for accelerating user growth, a point where the network seems to be taking on a life of its own. The third and most important component is to analyze the strength of the lock-in. A network effect creates a moat only if it's difficult for users to leave or to multi-tenant, use multiple competing networks simultaneously. For example, the network effect in social media is powerful because your social graph, your friends, photos, and history is locked into that platform. Recreating it elsewhere is a massive hassle, a high switching cost. Conversely, the network effect for ride-sharing apps like Uber and Lyft is weaker. While they are two-sided marketplaces, the lock-in is low. Many drivers have both apps open at once, and many riders will check both apps for the best price. The users are multi-tenanting, which erodes the moat and leads to more intense price competition. When performing a stock analysis, you must ask, how proprietary is the network? Can users easily recreate their network connections on a competing platform? Is the value unique to this specific network, or can it be accessed elsewhere? A business like LinkedIn has a very strong network effect, because a professional's reputation and connections are painstakingly built over years and are tied directly to that platform. It has strong lock-in. By using this 3-part framework, type, critical mass, and lock-in, you can move beyond simply saying, this company has a network effect, and begin to quantify its power and durability. It provides a structured way to think about the business strategy behind these unique companies, and to identify the ones that are on a path to true, lasting market dominance. The antithesis of the network effect mode is the business that actually gets worse as it gets bigger. This is a surprisingly common phenomenon, and it represents the path of the 99% who misunderstand the nature of scale. This is the world of the negative network effect, or diseconomies of scale. These are businesses where growth, beyond a certain point, doesn't strengthen the company but actively weakens it, eroding value and frustrating customers. A perfect example is an exclusive, high-end restaurant or club. Its initial appeal is its exclusivity, its intimate atmosphere, and the high level of personal service. When it's new and has a small, curated clientele, the experience is fantastic. But what happens when it becomes popular? The owners, chasing growth, might try to expand. They pack more tables in, the kitchen gets overwhelmed, the service quality drops, and the once exclusive vibe is lost. The very act of scaling destroys the magic that made it successful in the first place. The value for each individual customer decreases as more customers are added. This is the exact opposite of a network effect. Another example can be found in many service-based businesses, like consulting or creative agencies. In the beginning, a small, talented team can produce incredible work. As the firm grows, it's forced to hire more people. It becomes harder to maintain a consistent culture of quality. The best partners get stretched thin, unable to give personal attention to every client. The firm becomes bloated, bureaucratic, and less nimble. The average quality of the work declines. Growth leads to mediocrity. This is a trap that many entrepreneurs fall into. They are conditioned to believe that growth is always good, that bigger is always better. They fail to ask if their business model has the capacity to scale effectively. They chase revenue at the expense of quality and end up with a large, mediocre company instead of a small, excellent one. In the technology world, a negative network effect can occur when a platform becomes too crowded. Think of a dating app. In the early days, with a dedicated user base, the signal-to-noise ratio might be high. As it grows and attracts millions of users, it can become flooded with spam accounts, bots, and low-quality interactions. The platform becomes noisy and less effective, driving away the very users who made it valuable. Similarly, an online marketplace can become a victim of its own success if it fails to curate its sellers, becoming overrun with counterfeit goods and fraudulent listings, which erodes trust and diminishes the value of the network. Investors who don't understand this dynamic get burned by chasing growth in businesses that are fundamentally unscalable. They see a company that is growing quickly and assume that trend will continue, failing to see that the growth itself is planting the seeds of the company's future decline. The wise investor, the one practicing quality investing, understands that the asterisk quality of growth is far more important than the asterisk quantity. They look for businesses with true network effects, where each new customer adds value to the ecosystem, and they are deeply skeptical of businesses where growth simply means more congestion, more bureaucracy, and a diminished customer experience. This is the crucial difference between building a self-reinforcing flywheel and a self-destructing one. When a company successfully cultivates a network effect, its financial statements begin to look like a work of art. The economic power of this moat manifests in several extraordinary ways, creating a profile that is the dream of any long-term investor. The first and most dramatic impact is on the nature of its growth. A business with a network effect often exhibits exponential, viral growth rather than linear growth. Each new cohort of users brings in the next, larger cohort. This leads to a J-curve in revenue and user metrics. The business might struggle for years to reach critical mass, but once it does, the growth appears to explode overnight. This is because the network itself becomes the primary driver of customer acquisition. This leads to the second financial signature: extraordinarily low customer acquisition costs, CAC, at scale. In the mature phase of a network business, the CAC can approach zero. The business doesn't need a massive sales force or a huge advertising budget to acquire new users. The network does the work for it. People join because they are invited by existing users, or because they feel they have to in order to participate in their industry or social circle. This creates massive operating leverage. As revenue grows exponentially, the sales and marketing expenses stay flat or grow linearly. This causes the profit margin, specifically the operating margin, to expand dramatically. The company becomes more and more profitable as it gets bigger. This is the opposite of many traditional businesses that see their margins shrink as they scale. The third financial connection is the impact on market share. Because of the powerful psychological forces at play, network effect markets tend to consolidate around one or two dominant players. This player can end up with 70, 80, or even 90% of the market. This near-monopoly status gives them incredible pricing power. They can extract a significant portion of the value created on their network because the users have nowhere else to go. A financial analysis of a mature network business will often reveal monopolistic-level gross and operating margins, far exceeding those of companies in more competitive industries. Finally, these businesses often become incredibly capital-light. Once the core platform or technology is built, it can often serve millions or even billions of users with very little incremental capital investment. A software network can add its 10 millionth user for virtually zero marginal cost. This results in a spectacular return on invested capital, ROIC. The business generates enormous amounts of free cash flow, as it doesn't need to constantly reinvest its earnings into heavy machinery or physical infrastructure to grow. This torrent of cash can be used to strengthen the moat further, acquire potential competitors, or be returned to shareholders. The financial story of a successful network effect is one of explosive growth, collapsing customer acquisition costs, expanding margins, and a dominant market position. It is the story of how companies like Google, Facebook, and Visa became some of the most profitable and valuable enterprises in human history. It is the ultimate manifestation of a competitive advantage that not only defends the castle, but actively and automatically expands the kingdom. The fourth great moat is the most traditional and perhaps the most intuitive, yet it remains one of the most durable. This is the cost advantage moat. A company with this competitive advantage can produce and deliver its product or service at a structurally lower cost than its rivals. This allows them to do one of two things. They can either sell at the same price as competitors and enjoy a much higher profit margin, or they can lower their prices to take market share, driving less efficient competitors out of business. It is a moat built not on fancy branding or complex technology, but on relentless, brutal efficiency. To see this principle in its purest form, we must look at another of Buffett's masterpieces of an investment, Geico. Before Geico, the auto insurance industry was dominated by companies that used a massive, expensive network of agents to sell policies. These agents were paid a commission on every policy they sold, and that commission was, of course, baked into the customer's premium. Geico, which stands for Government Employees Insurance Company, was founded on a radically different idea. It would bypass the agents entirely and sell directly to a targeted group of low-risk customers, government employees, via mail and telephone. This was a revolutionary business strategy at the time. By cutting out the middleman, Geico created a massive structural cost advantage. Its operating costs were a fraction of its competitors. This cost advantage became the foundation of a virtuous cycle, a flywheel that has been spinning for decades. Geico could offer its insurance policies at a significantly lower price, often 15 to 20% cheaper than the agent-based companies. This price advantage was an incredibly powerful magnet for customers. Who doesn't want to save several $100s a year on a mandatory purchase like car insurance? As millions of customers flocked to Geico for its lower prices, the company grew rapidly. This scale, in turn, gave it even more cost advantages. Its fixed costs, like advertising and administration, could be spread across a much larger customer base, lowering the cost per policy even further. The bigger it got, the cheaper it could be. And the cheaper it could be, the bigger it got. Buffett first invested in Geico in 1951, but the major investment came in the mid-1970s. The company had made some poor underwriting decisions and was on the brink of bankruptcy. Wall Street panicked, convinced the company was doomed. The stock price collapsed. But Buffett, once again looking past the short-term problems, saw the unshakable power of the underlying business model. The low-cost advantage was still there. He knew that if the company could fix its underwriting, the powerful economic engine at its core would re-engage. He invested heavily, eventually taking the entire company private under Berkshire Hathaway. He was right. Geico not only survived, but thrived, growing from a niche player into one of the largest auto insurers in the United States. Its success was not based on having the friendliest agents or the cleverest marketing, though its gecko mascot certainly helped. It was built on the simple, brutal, and sustainable advantage of being the low-cost provider. This story teaches a vital lesson for long-term investing. A structural cost advantage is one of the most formidable moats a business can possess. It is not easily replicated. A competitor can't simply decide to be a low-cost producer. It requires a fundamental difference in business model, scale, or process that has been cultivated over years. This is the moat that allows a company to not just survive, but to dominate even in an industry that sells a commoditized product. The power of a cost-advantage moat is amplified by a simple but powerful psychological bias known as hyperbolic discounting. This is our tendency to prefer smaller, immediate rewards over larger, later rewards. When it comes to purchasing decisions, this bias translates into a powerful preference for a lower-priced now. A customer might be told that a more expensive brand of insurance offers slightly better customer service or more features, but those are abstract, future benefits. The savings from choosing the lower-priced option are concrete, immediate, and tangible. For most people, the certainty of saving $200 today heavily outweighs the uncertain possibility of a slightly better claims experience months or years from now. Geico's business model is a masterclass in exploiting this bias. It presents the customer with a clear, simple, and immediate reward, a lower premium. The competitor is forced to argue for intangible future benefits, a much more difficult psychological sell. This is particularly effective in industries where the product is a, quote, grudge purchase, something customers are required to buy but don't particularly want, like insurance or utilities. In these cases, the desire to minimize the immediate financial pain is paramount, and the low-cost provider has a massive psychological edge. Another behavioral principle at play is the power of a simple value proposition. In a world of overwhelming choice and information overload, our brains crave simplicity. A business that competes on being the cheapest has the simplest and most easily understood value proposition of all. It can be communicated in a single sentence: "We will save you money." A competitor that tries to compete on multiple dimensions, quality, service, features, brand, has a much more complex story to tell. They have to educate the customer and convince them that these other attributes are worth paying a premium for. The low-cost player's message cuts through the noise like a hot knife through butter. This is a critical lesson in entrepreneurship advice. If you cannot build a moat based on brand or network effects, then the clearest path to success is often to relentlessly pursue a cost advantage and build your entire marketing message around that simple, powerful promise. It removes ambiguity and makes the purchasing decision easy for the cognitively overloaded consumer. The very identity of the business becomes intertwined with the concept of value. This creates a strong positioning in the customer's mind. When they think, "I need to save money on car insurance," they automatically think Geico. This mental association is a powerful asset, a form of brand equity built not on emotion, but on the cold, hard logic of economic self-interest. The low-cost model, therefore, is not just a financial strategy. It is a psychological one. It leverages our innate desire for immediate gratification and our preference for simple, clear choices to create a powerful and sustainable competitive advantage. How can you, as an investor conducting a stock analysis or an entrepreneur planning a business, identify a true and durable cost advantage? It's not enough for a company to simply be the cheapest right now. The advantage must be structural. Here is a blueprint, a cost structure analysis model, to help you separate the temporary price cutters from the true low-cost champions. There are three primary sources of a durable cost advantage you must look for. The first source is process-based advantage. This comes from having a unique, more efficient method of producing or delivering a product or service. This was Geico's initial advantage. Its direct-to-consumer model was a fundamentally more efficient process than the traditional agent-based model. Another classic example is Dell in its heyday. Its build-to-order, direct sales model eliminated the need for costly inventory and a retail middleman, allowing it to sell PCs for significantly less than competitors like Compaq or IBM. When analyzing a company, you must dig into its operations. Don't just look at the financial statements. Understand how it does what it does. Is there a proprietary technology, a unique logistical system, or an innovative business model that gives it a structural cost edge? The second and more common source is scale-based advantage. This is the most famous type of cost advantage, where a larger company can produce goods more cheaply than a smaller one. This advantage comes from several places. First, purchasing power. A massive retailer like Walmart can negotiate much better prices from its suppliers than a small mom-and-pop store can. Second, spreading fixed costs. A large manufacturing plant that runs 24/7 has a lower per-unit production cost than a small plant that only runs one shift. The fixed costs of the factory, the building, the machinery, are spread over a much larger volume of output. This is a key driver of high profit margins in manufacturing and logistics. To identify this, you must analyze the company's market share and its relative scale compared to its competitors. Is it the dominant player in its industry? Does the industry have high fixed costs, which would mean that scale provides a significant advantage? The third source of cost advantage is location-based advantage. Sometimes, a company's physical location gives it a structural cost edge. A mining company that owns a rich, easily accessible ore deposit will have a lower cost of extraction than a competitor with a lower-grade, harder-to-reach mine. A waste disposal company that owns the only landfill in a 100-mile radius has a massive cost advantage over any potential competitor who would have to pay to transport waste much further. This location-based advantage can also apply to owning critical infrastructure or having access to a unique, low-cost source of raw materials or labor. When performing a company analysis, you must ask, does this company own or control a unique physical asset that gives it a permanent cost advantage? By using this three-part framework, process, scale, and location, you can dissect a company's cost structure and determine if its low prices are the result of a sustainable moat or merely a temporary and likely suicidal pricing strategy. This is the key to quality investing in industries that might otherwise seem unattractive or commoditized. The path of the 99% in a competitive landscape is to be stuck in the middle. This is the disastrous antithesis of a clear cost advantage strategy. A business that is stuck in the middle is one that is neither the low-cost leader nor a differentiated premium provider. It tries to be a little bit of everything, and as a result, it is a master of nothing. This is one of the most common failure modes in business strategy. Imagine an airline. On one end of the spectrum, you have a low-cost carrier like Spirit or Ryanair. Their message is crystal clear. We will get you from point A to point B for the lowest possible price and nothing more. They have relentlessly engineered their entire business model around this goal, using a single type of aircraft, flying to secondary airports, charging for every single amenity. They have a clear cost advantage moat. On the other end of the spectrum, you have a premium international carrier like Singapore Airlines or Emirates. Their message is also clear. We offer a superior, luxurious experience, and you will pay a premium for it. They differentiate on service, comfort, and brand. They have a brand moat. The company that is stuck in the middle is the one that tries to offer slightly better service than the low-cost carrier, but at a price that is significantly higher. And it tries to offer a price that is lower than the premium carrier, but with a product that is clearly inferior. It has no clear value proposition. It fails to attract the price-sensitive customer, who will always choose the absolute cheapest option. And it fails to attract the quality-sensitive customer, who is willing to pay for the best. It gets squeezed from both sides. Its customers are those who couldn't get a good fare on the cheap airline or couldn't afford the premium one. There is no loyalty. This is the fate of many legacy department stores. They couldn't compete with Walmart or Amazon on price and efficiency, and they couldn't compete with luxury boutiques on brand and service. They were stuck in the middle, and they were crushed. Entrepreneurs often fall into this trap out of fear. They are afraid to be the absolute cheapest because they worry about low margins. They are afraid to be a true premium brand because they worry about a smaller market size. So they compromise. They try to be affordable quality. But this is often a recipe for mediocrity and failure. It's a fuzzy, unclear position that doesn't inspire passion or loyalty. Investors who invest in these companies are betting on a muddled strategy. They might see what appears to be a reasonable valuation, but they fail to see the lack of a competitive advantage. These businesses are highly vulnerable to economic downturns and competitive attacks from both the high and low ends of the market. They have no fortress, no moat. They are fighting a two-front war on an open field, and they are destined to lose. The lesson is clear. In the world of business strategy, you must make a choice. Either be the master of cost and efficiency, or be the master of brand and differentiation. The middle of the road is the road to ruin. The financial signature of a business with a durable cost advantage is clear, powerful, and deeply attractive to a value investing practitioner. It provides a level of resilience and profitability that is hard to achieve otherwise. The most direct and obvious manifestation is a consistently higher profit margin than its competitors. Let's look at two companies in the same industry. If one has a structural cost advantage, it might have a gross margin of 40% and an operating margin of 20%. A less efficient competitor might have a gross margin of 30% and an operating margin of 10%. They're both selling a similar product at a similar price, but the low-cost producer is converting far more of its revenue into actual profit. This superior margin is the direct financial return on its efficiency. Second, a cost advantage allows for greater resilience during economic downturns or industry price wars. When demand slumps and all companies are forced to lower their prices to attract business, the high-cost producers see their slim profit margins evaporate. They may start losing money on every sale. The low-cost producer, however, can lower its prices and still remain profitable. This allows it to not only survive the downturn but to actually gain market share as its weaker rivals go bankrupt. A financial analysis that looks at performance through a full economic cycle will reveal the true strength of a cost advantage moat. The company's margins will be far less volatile than its peers. Third, a cost advantage leads to a superior return on invested capital, ROIC. An efficient business simply needs less capital to generate the same amount of revenue. A retailer with a highly efficient supply chain and inventory management system, like Walmart, has less money tied up in warehouses and unsold goods. A manufacturer with a superior process can produce more output from the same factory. This capital efficiency is a powerful engine of value creation. It means the company can grow without needing to constantly raise new capital or take on more debt. It can fund its own growth from its internal cash flows, a hallmark of a truly great business. Finally, the low-cost producer has strategic flexibility. It can choose to either maintain price parity with competitors and pocket its cost advantage as a higher profit margin, or it can choose to strategically lower prices to drive a competitor out of the market. This ability to initiate and win a price war is a powerful weapon. Knowing that you can sustain lower prices for longer than anyone else in your industry gives you immense strategic power. In summary, a cost advantage moat is not just about being cheap. It is a powerful economic engine that translates into sustainably higher profit margins, greater resilience, superior returns on capital, and strategic dominance. It is the numerical proof of a business that is not just well run, but fundamentally better built than its competition. Our final destination in this exploration of economic moats is perhaps the most absolute and formidable of all. This is the toll bridge moat, the competitive advantage that comes from owning a unique, often legally protected or geographically constrained asset that competitors simply cannot replicate. It's not about being better, cheaper, or more loved. It's about being the only game in town. The business with a toll bridge moat doesn't need to compete because it owns the entire road. To understand the sheer, raw power of this moat, we must examine what is arguably the perfect modern example in Buffett's portfolio, the Burlington Northern Santa Fe (BNSF) Railway. In 2009, in the depths of the Great Recession, Buffett made his biggest bet ever, acquiring the entirety of BNSF for $44 billion. He called it an all-in wager on the economic future of the United States. Why would he bet so much on something as old-fashioned as a railroad? Because he recognized it as one of the greatest toll bridges in the world. BNSF owns and operates over 32,000 miles of track, primarily in the western United States. This network of steel is a critical artery of the American economy, transporting everything from coal and grain to consumer goods and industrial products. Now, ask yourself, could you build a competing railroad right next to BNSF's? The answer is a categorical no. First, you would have to acquire the rights of way for thousands of miles of land, an almost impossible and astronomically expensive task. Second, you would have to spend hundreds of billions of dollars laying track, building bridges, and digging tunnels. Third, you would have to navigate a labyrinth of environmental regulations and local permits. It is, for all practical purposes, impossible. BNSF has a geographic monopoly over its routes. It is the ultimate, non-replicable asset. If a coal mine in Wyoming needs to get its product to a port in the Pacific Northwest, it has very few choices. Often, BNSF is the only viable option. This gives the railroad immense pricing power. It doesn't have to be the cheapest way to ship goods. It just has to be cheaper than the next best alternative, which is often trucking. And for heavy bulk commodities shipped over long distances, rail has a massive, inherent cost advantage over trucks. This means BNSF can charge a price that is just below the cost of trucking and capture a huge profit margin. It is a toll collector on American commerce. Buffett saw that as the country grew, the demand for moving physical goods would inevitably increase, and BNSF, the irreplaceable asset, would be there to carry them. It's a business with high barriers to entry. In fact, the barriers are essentially infinite. It has a durable cost advantage for its core function. And it is fundamentally tied to the long-term prosperity of the nation. Other examples of toll bridge moats include things like government-granted patents for a pharmaceutical company, which give them a legal monopoly on a drug for a set period, or a waste management company that owns the only permitted landfill in a region, a regulatory moat, or an airport or seaport that controls access to a major city, a geographic moat. The common thread is scarcity. The asset, whether it's a railroad network, a patent, or a piece of land, cannot be easily duplicated. This scarcity is the source of its immense and durable economic power. This is the final frontier of quality investing, finding those rare businesses that have moved beyond competition and into the realm of pure, structural dominance. The psychological power of the toll bridge moat is driven by one of the most primal and influential principles of human behavior, the scarcity principle. As articulated by psychologist Robert Cialdini in his seminal work Influence, we humans place a higher value on things that are scarce or less available. When an option is perceived as the asterisk-only ties option, its value in our minds skyrockets. The toll bridge business leverages this principle to its absolute maximum. When a customer has no viable alternatives, their decision-making process changes fundamentally. They are no longer in a mode of comparison or evaluation. They are in a mode of acceptance. The question is not, which provider should I choose, but rather, what price must I pay to the only provider available? This shifts the balance of power almost entirely to the seller. The scarcity of the asset creates a sense of urgency and importance. The service provided by the railroad or the patented drug is not just a convenience, it is a necessity. This psychological framing allows the company to command prices that would be unthinkable in a competitive market. Furthermore, the very permanence and irreplaceability of the asset create a sense of stability and inevitability that can be deeply reassuring. A railroad has been there for 100 years and will likely be there for 100 more. This perception of permanence creates a powerful status quo bias. Industries and supply chains are literally built around the existence of these toll bridges. To reconfigure them would be so disruptive and costly that it becomes unthinkable. The asset becomes part of the unquestioned infrastructure of the world, as fundamental and non-negotiable as a river or a mountain range. This is why a regulatory moat, like a government license to operate a casino or a utility, is so valuable. It is a state-sanctioned scarcity. The government has artificially limited the supply, creating a protected profit stream for the license holder. This creates a psychological barrier in the minds of potential competitors. The thought of fighting a legal and political battle against an entrenched, government-blessed incumbent is so daunting that most will never even try. The toll bridge moat, therefore, operates on a higher psychological plane. It doesn't just influence a purchasing decision. It defines the entire landscape of possibilities. It creates a reality where there is only one choice, and it leverages our deep-seated psychological response to scarcity to extract maximum economic value from that reality. How can you, as an investor or entrepreneur, systematically identify a business with a true toll bridge moat? This requires a different kind of analysis, one focused less on customer behavior and more on structural industry dynamics. Here is a blueprint for applying the toll bridge test to any company. It consists of 3 critical questions. The first question is, are there significant barriers to entry? And you must be ruthless in your definition of significant. A strong brand is a barrier, but it can be overcome. A great product is a barrier, but it can be copied. A true toll bridge moat has barriers that are close to absolute. The most common are regulatory barriers, capital costs, and physical scarcity. Ask yourself, would it be legally permissible for a competitor to enter this market? Does the government restrict the number of licenses? Would a competitor need to spend an obscene amount of capital, rivaling the GDP of a small country, just to get started? Does this company own a unique physical asset that is geographically limited and cannot be duplicated? If the answer to these questions is a resounding yes, you may have found a toll bridge. The second question is, does the company have a high degree of pricing power that is not dependent on customer satisfaction? This is a crucial and subtle point. A company with a strong brand has pricing power, but it is contingent on maintaining that brand's reputation. If See's Candies started selling terrible chocolate, its pricing power would eventually erode. The pricing power of a true toll bridge, however, is often independent of service quality. Your local cable company might have terrible customer service, but if it's the only provider of high-speed internet to your home, you will pay your bill every month. The railroad's customers might not love BNSF, but they need its services to run their businesses. The pricing power comes from the lack of alternatives, not from delighting the customer. When doing a financial analysis, look for a history of steady price increases that outpace inflation, even if the company isn't a beloved consumer brand. The third and final question of the toll bridge test is the demand for the company's service durable and likely to persist for decades? A patent for a revolutionary new drug is a powerful toll bridge, but it is temporary. Once the patent expires, the moat is gone. A truly great toll bridge is one that is built on a fundamental, near-permanent human or economic need. People will need to move goods across the country for the next century. People in a city will need electricity and water. People will generate trash that needs to be disposed of. An investment in BNSF is a bet on the durable need for physical transportation. An investment in a regulated utility is a bet on the durable need for power. By rigorously applying this 3-part test, absolute barriers to entry, pricing power independent of goodwill, and durable demand, you can identify the rare businesses that operate as modern-day toll bridges. These are the buy and hold forever investments that can form the bedrock of a multi-generational fortune. They are the ultimate expression of a business that is built not just to compete, but to endure. The antithesis of the toll bridge moat is the business that operates in an industry with 0 barriers to entry. This is the path of the 99%, the world of perfect competition, where new rivals can appear overnight, with nothing more than a laptop and an internet connection. It is the easiest type of business to start, and for that very reason, it is the hardest type of business in which to succeed. Think about opening a coffee shop, a landscaping business, or a generic marketing agency. What does it take to get started? A relatively small amount of capital, a few basic skills, and a business license. There are no regulatory hurdles preventing you from opening. There are no massive upfront capital costs. There are no scarce physical assets you need to control. Because the barriers to entry are so low, these industries are perpetually, hopelessly crowded. For every successful coffee shop, there are a dozen that fail within the first year. The moment one entrepreneur proves that a certain neighborhood can support a new restaurant, 5 more will open up down the street. This constant influx of new competition puts relentless downward pressure on prices and profit margins. It's impossible to build any sustainable pricing power. If you try to charge too much for your lattes or your lawn mowing services, a customer can and will find someone else to do it for less in a matter of minutes. The life of an entrepreneur in this type of business is one of constant, grinding struggle. You are never safe. You can never relax. Your success today is no guarantee of your success tomorrow. You are always just one new competitor away from a price war that could put you out of business. Many small business ideas fall into this category. The dream of being your own boss is seductive, but the reality of operating in a low barrier-to-entry industry is often a nightmare of long hours, intense stress, and meager financial returns. Investors who put their money into these businesses are often making a grave mistake. They might be attracted by a compelling local story or the passion of the founder, but they are ignoring the brutal economic reality of the industry structure. Without a moat, even the best-run small business is incredibly fragile. It is a sandcastle built at the edge of a rising tide. The key takeaway for both entrepreneurs and investors is that the attractiveness of a business is often inversely proportional to how easy it is to start. The truly great businesses, the ones that generate massive, long-term wealth, are the ones that are excruciatingly difficult, if not impossible, for anyone else to replicate. The 99% chase the easy ideas and find themselves in a bloody battle for survival. The wise few seek out the toll bridges, the businesses protected by insurmountable walls, and they reap the rewards of owning a true, unshakable monopoly. The financial signature of a toll bridge moat is one of profound stability, predictability, and effortless profitability. When you analyze the financial statements of a company like this, you are looking at an economic machine of the highest caliber. First, you will see incredibly stable and predictable revenues. Because they often provide essential services with inelastic demand, their top-line performance is largely insulated from the violent swings of the economic cycle. During a deep recession, people might buy fewer cars or take fewer vacations, but they will still use electricity, and the nation's goods will still need to be moved by rail. This revenue stability is highly prized by the market and leads to a premium valuation. Second, you will observe consistently high and often expanding operating margins. Their monopoly or oligopoly position gives them immense pricing power. They can pass on any increases in their own costs, like fuel or labor, directly to their customers. Their margins are not subject to the same competitive pressures as a normal business. A deep dive into their financial history will show a long-term trend of prices rising and margins remaining robust, a clear sign of a powerful moat. Third, and most importantly for a long-term investor, these businesses are often prodigious generators of free cash flow. While they may require significant capital to maintain their large asset bases, like a railroad maintaining its tracks, their pricing power and stable demand ensure that they produce cash far in excess of these needs. This is the owner's cash that Buffett prizes so highly. This massive, predictable stream of cash flow can be returned to shareholders year after year in the form of dividends and share buybacks, providing a steady and growing return on the investment. A thorough financial analysis of a company like BNSF or a major regulated utility will show a cash flow statement that is both massive and beautifully consistent. Finally, the return on tangible assets is often deceptively high. While these companies have enormous asset bases, the key is that these assets are irreplaceable. The return generated by a unique railroad network cannot be compared to the return generated by a generic factory that could be built by anyone. The quality of the assets is off the charts. The financial statements tell a story of a business that doesn't need to be clever or innovative. It doesn't need to launch flashy new products. It simply needs to exist, to open its toll gate every morning and collect the fees from the commerce that must, by necessity, flow through it. It is the story of a business that has transcended competition and has become a piece of the fundamental economic infrastructure, a story of the ultimate financial fortress. You have just been given a powerful lens, a new way of seeing the world of business and investing. You've moved beyond the noise of daily market fluctuations and the shallow analysis of quarterly earnings reports. You now understand that the true source of lasting wealth is not growth, not innovation, not even hard work, but the existence of a durable, structural competitive advantage. You have the blueprint for identifying the 5 great economic moats: the power of a brand in the mind, the friction of switching costs in a workflow, the magnetic pull of a network, the brutal efficiency of a cost advantage, and the absolute power of a toll bridge. This is not just theory. It is a practical mental toolkit that separates the 99% of investors who gamble from the 1% who build dynastic fortunes. You have invested your time, and in return, you have acquired a framework that can fundamentally change your financial future. But what we have done today is map a single crucial continent on a much larger globe. The system Warren Buffett uses is not just a collection of isolated ideas. It is a complex, interconnected web of mental models. Understanding moats is the first and most critical step, but it is just one piece of the puzzle. A fortress is useless if you pay too much for it. A great business bought at a foolish price is a terrible investment. The principles of identifying a moat must be linked to the discipline of valuation. The art of calculating intrinsic value, the discipline of waiting for the fat pitch, the temperament to act with courage when others are fearful. These are the connecting roads, the shipping lanes that link the continent you've just mastered to the rest of the world of wisdom. The video that is now on your screen, the one the algorithm has chosen for you, is not an accident. Think of it as the next piece of the map. It holds the key to linking what you've learned today about what point to buy, with the equally important discipline of when to buy it. The knowledge you've just acquired about competitive advantage is a powerful engine. But without the steering wheel of valuation and the brake pedal of emotional control, it can still lead you off a cliff. The next step in your journey is to build out that control system, to forge the link that connects the quality of the business to the price you are willing to pay. This is the bridge from being a company analyst to becoming a true capital allocator. The choice is yours. You can stop here, with one powerful tool in your arsenal, or you can continue the journey. You can choose to complete the mental model, to build the entire intellectual framework that has proven, for over half a century, to be the most reliable path to financial freedom. This isn't about watching another video. This is about a decision to continue your ascent, to refuse to be one of the 99%, and to fully arm yourself with the complete mental arsenal of the world's greatest investor. The next piece of the puzzle is waiting. Click and continue the journey.